Most people think crypto failure is about bad luck. It's not. It's actually a math problem you are never taught to solve. By the end of this, you will see exactly why your current strategy is designed to fail and how you can flip the script. Stop being exit liquidity for the pros and learn how to beat the odds starting right now. Let's be honest with ourselves for a second. When you open up a decentralized exchange and see a token up 4,000% in the last hour, what do? Your heart rate spikes, your fingers starts moving before your brain catches up. You're not investing, you're gambling, and the house always wins. The 2026 AI crypto surge has created an environment where retail investors are treating a generational technological shift like a lottery ticket. Instead of asking what a project actually does, who is building it, and whether it solves a real problem, the vast majority of crypto participants are chasing green candles on decentralized exchanges, hoping they'll are enough to cash out before the inevitable dump. This is not a strategy, this is a prayer. Here is the uncomfortable truth. The psychological phenomenon driving this behavior has a name. It is called loss aversion bias compounded by FOMO, or fear of missing out. When you see others posting gains, your brain processes the missed opportunity as a little loss. Your amygdala lights up the same way it would if someone stole money from your wallet. This biochemical response overrides rational decision making, and that is exactly what predatory actors in the crypto space count on. This is the casino trap. And until you recognize that you are studying inside it, every trade you make is a bet against a stacked deck. Now let me show you who is on the other side of your trades. While you're emotional, panicked, and manually clicking buy and sell, institutional desks are operating with algorithmic precision. They do not feel fear, they do not feel greed, they do not stay up at night refreshing CoinGecko. They run quantitative models that profit from your volatility. Large-scale institutional liquidity providers use complex hedging and automatic rebalancing to extract consistent returns regardless of market direction. When you panic sell, their algorithms buy. When you fear of missing out buy or FOMO buy at the top, their systems are distributing into your buying pressure. This is not a conspiracy, this is a market structure. And understanding it is the difference between being farmed and being the farmer. This is why tracking on-chain flow data is not optional. It is survival. When you see smart money wallets accumulating a specific asset during a market lull, when whale addresses are quietly building positions while retail is panicking, that is the signal. That is the invisible hand showing you where the real conviction lies. Tools like Kakam, Nansen, and on-chain analytics dashboards are no longer luxury accessories for crypto nerds. They are essential infrastructure for anyone who wants to stop being on the losing side of the trade. By the way, the institutions are not smarter than you. They are more systematic. And a systematic approach will beat an emotional one every single time. Here is something nobody wants to hear. Most failing investors are ignoring the actual technology that will determine which projects survive. The crypto space is not what it was in 2021. The infrastructure layer has evolved dramatically, and if you are still evaluating projects based on hype, community size, and meme potential, you are driving blindfolded on a highway. The shift towards modular blockchains and zero-knowledge proofs is not a niche technical trend. It is a fundamental architectural transformation that will determine which chains can scale, which can offer privacy, and which will become obsolete. Modular design separate execution, consensus, and data availability into specialized layers. This means fast throughput, lower costs, and more flexible development environments. If you are investing in monolithic chains that cannot adapt to this modular future, you are holding tomorrow's Kodak. Zero-knowledge proofs are equally transformative. They allow one party to prove something is true without revealing the underlying data. In practical terms, this means transactions that are both private and verifiable, compliance-friendly DeFi, and identity systems that do not require you to hand over your personal information. And projects building with ZK technology are just positioning themselves for the regulatory environment for 2027 and beyond. This means that hype-based tokens are just positioning themselves for a slow death. And then there is interoperability. The current ecosystem is multi-chain. Ethereum, Solana, Cosmos, various app chains, and rollups all need to communicate. Interoperability protocols are the backbone of this multi-chain world. Without them, assets and data remain siloed, and users remain trapped on individual chains. Projects that solve cross-chain communication, atomic swaps, and unified liquidity are building the highways of the next generation of crypto. If you cannot explain why interoperability matters for a token you hold, you should not be holding it. Finally, the most basic filter is developer activity. A project with ghost GitHub, zero commits, and no active development is not a project. It is a marketing campaign with a token attached. Look at developer commits, contributor count, and protocol revenue before you allocate a single dollar. This is the technical barrier to entry that separates the informed from the uninformed, the profitable from the wiped out. Now we get to the part that actually changes your outcomes. Everything up to this point was a diagnosis. This is the prescription. The top 1% of crypto earners do not have better luck than you. They have better architecture. They have systems that protect them from themselves. The first pillar of that architecture is portfolio allocation models. The top 1% never go all in on a single thesis. They divide their capital into tiers. A core allocation in battle-tested assets like Bitcoin and Ethereum that they rarely touch. A set-rate allocation in high-conviction and mid-cap projects with real revenue and developer activity. And a small tactical allocation for asymmetric bets on emerging narratives. The key is that no single position can wipe them out. The maximum risk on any individual asset is capped, and the portfolio as a whole is structured to survive a 90% drawdown in any one sector. The second pillar is removing human emotion from the equation entirely. This means setting hard exit points before you enter a trade, not after, before. You decide your stop loss level and you take your take profit target at the moment of entry, and you automate them. Most exchanges and trading platforms already support automated limit orders, trading stops, and conditional sales. Use them. The moment you start manually deciding when to exit based on how you feel, you have already lost, because your feelings are the least reliable data point in your entire strategy. The third and most advanced pillar is transitioning from speculative gambling to a delta-neutral mindset. Delta-neutral strategies aim to remove directional risk entirely. You're not betting that the market goes up or down. You are collecting yield from providing liquidity, from staking, from options, premiums, from funding rate arbitrage. These strategies thrive in both bull and bear cycles because they do not depend on market direction. They depend on market activity, and crypto markets are always active. This is the architecture that separates the 1% from the 99%. It is not glamorous. It is not a moonshot. It is a system. And systems beat emotions every time. A thesis-driven approach means you invest based on a conviction about where the industry is heading, not based on what is pumping today. For example, if your thesis is that decentralized physical infrastructure networks, or DePIN, will become the backbone of real-world data processing in the next 3 years, then you allocate capital towards projects building in that sector, and you hold through the noise. Daily price movements are irrelevant to a 3-year thesis. What matters is whether the fundamental trajectory of the sector validates or invalidates your thesis. If it validates, you add. If it invalidates, you exit. No drama, no panic. Just disciplined reassessment at predetermined intervals. Continuous education is not optional in this space. The crypto landscape shifts every quarter. Emerging sectors like the PIN, real-world asset tokenization, AI agent economies, and ZK roll-up scaling are evolving rapidly. If you're not spending at least 2 hours a week reading protocol documentation, following developer discussions, and understanding new infrastructure, then you're falling behind. The investors who survive are the ones who treat crypto like a profession, not a hobby. And here is your immediate action plan. Right now, after this, I want you to do 3 things. First, audit every token in your portfolio and ask yourself, can I explain the fundamental utility of this project in 1 sentence? If you cannot, it does not belong in your portfolio. Second, set automated take profit and stop loss levels on every position you hold. Remove the emotional decision making from your exits. Third, pick one emerging sector that aligns with the long-term thesis and begin a systematic research process. Build your conviction on substance, not on hype. If you made it this far, you are already ahead of 99% of crypto investors because most people will never even confront these truths. But knowing is not enough. You have to act. Thank you for staying put through this. If you learned something here today, then please share this with your friends and please subscribe to this channel and hit the notification bell. We are building the intelligence layer for crypto investors who refuse to be exit liquidity. Visit guavaintel.com for deeper research, on-chain analysis tools, and resources that will help you build the architecture that we talked about today. Thank you again, and I hope to see you on the next one. Cheers, guys.